Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing HIMX's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. HIMX is a fabless semiconductor company. Fabless means the company outsources manufacturing of its silicon wafers and chips. Fab is short for fabrication, which is just another word for manufacturing. HIMX is a market leader in display driver internet circuits and timing controllers used in TVs, laptops, monitors, mobile phones, tablets, digital cameras, car navigation systems, virtual reality devices, and much more. It has a 40% market share in driver integrated circuits for auto displays. The company has over 200 customers across Taiwan, China, Japan, Korea, US, and Europe. It has over 3,000 patents granted and 500 pending approval. The company is headquartered in Tainan City, Taiwan, and was founded in 2001. The ticker trades on the Nasdaq, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a mid-cap company, $2 billion market cap. They're trading at $12 a share, and they have 174 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had the most free cash flow in 2021 by far, $380 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's also highest in 2021 at over $400 million. Revenue is a sales for the company, and that more than doubled from 2018 to 2021. It's over $1.5 billion. This is the company's income statement. The top line is the revenue of the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grew a ton from 170 million to 750 million. Below that is our operating expenses. The largest is research and development. Gross profit minus operating expenses gives you your operating income. And that was negative in 2019. It was a small positive in 2018. Now it's over $500 million. They spent $1 million of interest on their debt, which is lower than the prior 3 years. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. An example is the gain or loss on investment. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is your net income, which grew more than 70 times from 2018 to 2021. It grew about 9 times from 2020 to 2021. This is the company's income statement from their annual report, and this shows us 2020 and 2021. Their revenue in 2020 was $1.5 billion. This is their annual revenue since 2004, and they just blew it out the water in 2021. This black line is the total units sold, and they sold less units in 2021 than pretty much every year the past 10 years. And they have higher revenue. That means their margins are really high in 2021. Their margins doubled from 2020 to 2021, close to 50%. Increasing revenue is great, but if you're not profitable, it doesn't mean much. They increase revenue and increase margins even more. Their cost of revenue is $800 million. Their gross margins are pretty close to the industry average. But look at their net margins, 28%. The average is negative and the median is only positive 11%. Net margin is net profit over revenue. Gross margin is gross profit over revenue. They always spend a lot in R&D, $150 million, because they actually design the chips. Then a third party does the manufacturing. That's the same thing NVIDIA does. They design the chips and send them out for manufacturing. Intel does both. They design and manufacture. Taiwan Semiconductor is the largest semiconductor company, and they just do manufacturing. When a company just does manufacturing, it's called a foundry. This company is fabless. $29 million in general and administrative, $23 million in marketing. Their operating income went up almost 10 times from $58 million to $545 million. They spent less interest on their debt in 2021 compared to 2020. And their net income was a lot higher, $434 million compared to $45 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They were barely generating any cash flow in 2018 and 2019. It grew a lot in 2020, then almost quadrupled to 2021. They spent $8 million in CapEx in 2021. They spent a lot more in 2018 and 2019. Operating cash flow minus CapEx gives you your free cash flow. And they do pay a dividend with their free cash flow, but most of the excess cash is used to invest back into the business to grow it. They add a similar amount of debt as they pay down each year. This is their operating cash flow section from their annual report. And they generated $388 million of cash flow in 2021 compared to $100 million in 2020. They reported a net profit of $434 million, but generated less cash flow. The big negative is accounts receivable. They extended $166 million of credit. When those customers pay for the product, then it'll be a cash inflow. So maybe 2022 we'll see a cash inflow in accounts receivables. They also bought a lot of inventory in 2021. When they actually use the inventory, then it's a cash inflow in that accounting period and it moves on to the income statement. But when the inventory is sitting on their balance sheet, it's like a cash outflow. But if you only adjust for the non-cash items on the income statement, they did generate more cash flow than net income. The income statement reports $110 million of income taxes. Since the income statement uses accrual accounting, we add that number back. The actual cash that left the company was $19 million, so we minus that out here. I like to track a company's revenue, that's a blue line, and operating cash flow, that's an orange line. It was pretty much flat from 2015 to 2020, but the company's really hit its stride. Semiconductors are in high demand, and this company is really taking advantage of that. This dramatic growth can't last forever, so it looks like it's supposed to grow a little bit in 2022, then remain pretty flat. Same thing with their operating cash flows. But even if they can maintain this growth, they should do really well in the future. This is their investing cash flow section from their annual report. This is 2020 and 2021. In 2021, they spent $8 million in PP&E, $25 million from buying financial assets, and another $23 million of acquisitions of financial assets. They sold $29 million of financial assets, a cash outflow of $213 million in refundable deposits. These are customer deposits that are refundable if the company doesn't complete the contract it has with that customer. This is their financing section from the statement of cash flows. They paid $47 million of dividends. They took on $600 million of debt, paid down $560 million of debt, and a bunch of other items. So they had a cash outflow of $5 million in 2021. Last year was a cash inflow of $3 million. This is the equity section on their 12/31 balance sheet. They have $870 million of equity. They raised $200 million from selling their business, and they profited $660 million from running their business. Let's look at the capital structure. $870 million of equity, $200 million of debt. They're 81% equity, 19% debt. And they could pay off all the debt with the cash on their balance sheet and still have $160 million of cash left over. Look how much their equity balance has grown in 2021. That's the blue line here. It was flat since 2015. Their cash balance is at its highest level. It's now a good amount higher than their debt balance. So it looks like 2021 was the big year for this company. I gave them the highest whack on Finbox, 9%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $2.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.5 billion. We divide that by 174 million shares, and we get a calculated stock price of $15. They're trading at $12, so they're trading at a 20% discount. It's a buy according to the model. Their revenue is projected to grow 3% a year, so I grew their revenue 3% for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. In the past 4 years, they converted 10% of their revenue into free cash flow. Even with these two negatives, it still averages out to 10%. So I multiplied their future revenue estimates by 10%. That's how I got their future free cash flows. Even with a really conservative model, a high WACC, using these negatives, I'm still coming out with a stock price higher than they're trading at. The website Simply Wall Street values the company at $35. They're saying it's 67% undervalued. One analyst priced this stock and their price target is $15. This is where the stock has been trading the last 5 years. It was about $13 a share at the end of 2017. Then it started dipping well before COVID. It hit its lowest point in 2019. I wish I had the foresight to identify this. I never heard about this company until this year. It looks like the stock was about $5 in March, and then when COVID came, it did dip. But most stocks came up a lot in March, April, and May. This really didn't move too much until looks like September. And then it went from $3 past $15. And then it was up and down for several months. You may think this is a bad time to buy it because it was so low. But the stock is trading lower than it was 4 years ago in the beginning of 2018. I think it was really undervalued back here, and now it's trading at the appropriate level. In the past 5 years, this stock is up 25%, while the S&P is up 94%. But you can see the S&P 500 is not nearly as volatile as this stock. This stock was above the S&P 500 at a few points, but well below it for several years. They pay an annual dividend, and they did bring it back. They did not pay a dividend in 2019 and 2020. They pay a 2.3% dividend yield, which they can easily afford. It's only 12% of their free cash flow, 11% of their net income. Their dividend yield was 12% in 2011. And then it's been pretty low, below 3% for about 10 years. But the forecast is for their dividend to grow to 18%. That does seem really high, but if the stock price stays so artificially low and they raise their dividend, which I do think is likely because they have so much cash flow, then it might get up to these levels. This is a really volatile stock. It has a beta of 2. It moves 2 times the market. It's only gone up 2% in the past 52 weeks, while the S&P is up 14%. The 52-week low is 950, the high is 17. And the stock is trading between its 50-day and 200-day moving average. 3 to 4 million shares are traded each day on this stock. Of the 174 million shares outstanding, 116 million are on float. 29% are held by institutions, and it has a high short percentage. Over 14% of the shares are shorted. Their employee count peaked in 2018 and 2019. It looks like they laid off some people, and they kept it pretty flat the past 2 years. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you would have been on a roller coaster ride. Although it would have been positive the whole time. But even if your investment is up, you're not happy. Because if your $10,000 went up to about $60,000, you'd be, of course, really happy. But then if it went down to $30,000, you wouldn't be happy you had $30,000. You'd be annoyed because you used to have $60,000. But then if it went up to $80,000, you'd be extremely happy that you held on. But if it went down to $15,000, you would have been really upset. Hopefully not standing on a ledge of a bridge, but you would have been upset. And a lot of people would have sold, but if you held tight, you'd be at over $70,000 today. That's a 22% annual return, a 622% total return. The general public owns 42% of the company, 28% by insiders, 25% by institutions, and 5% by hedge funds. The CEO of the company is the biggest shareholder at 22%. His value is $438 million. Then another person owns 6%. A fund owns 5%, Acadian owns 2.4%, then AllianceBernstein. Let's look at their financial ratios. They have amazing price multiples, a PE below 5, price to sales of 1.3, and a price to book of 2.3. Let's look at their non-current assets, 3.3 million of equity investments. These are their investments in other companies, 133 million of PP&E, 7.2 million of deferred tax assets. This should decrease their taxes in the future. 28 million of goodwill. Goodwill is the premium you pay when you acquire another company. 6.6 million of other intangibles. This can be computer software, patents, or trademarks. 200 million of customer deposits and 18 million of other. Let's look at their non-current liabilities. 47 million of debt, 10 million of contract liabilities. This is similar to earn revenue. When a contract is completed, they can take this dollar amount off their balance sheet and book it as income onto the income statement. And 72 million of other. They have a really good return on invested capital of 62%. They don't have much debt, so they can easily cover the interest on their debt. They have a top-notch ROE of 50%. They can cover their current liabilities with their current assets 2 times, and their quick ratio is 1.7. Let's look at their current assets. 336 million of cash, 28 million of financial assets, 410 million of receivables. This is how much money is owed to them. So it looks like they do extend a lot of credit. 200 million of inventory, 150 million restricted cash. This is cash that's set aside for a specific purpose, like to acquire another company. And 64 million of other. Let's look at their current liabilities. 6 million of debt, another 151 million of debt, 248 million of payables. This is how much money they owe others. 97 million of income taxes payable. This is how much money they owe the government within the next 12 months in taxes. 38 million of contract liabilities and 59 million of other current liabilities. In 2021, they generated 380 million of free cash flow. They have almost 600 million in working capital, and they paid out only 47 million in dividend payments. So they have over 900 million of funding. So it looks like the company is pretty well capitalized. The best way to look at ratios to compare them to companies in the same industry. There are 67 companies in the same industry as Himax, and if Himax has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they pay a really good dividend, much higher than average. They rank 39th in market cap at 2 billion. The average is 43 billion. I just noticed this now. Taiwan Semiconductor is not the largest company, it's Nvidia. Their stock price has come down so much in the past few months. They're now number 2. And they're not even that close to Nvidia. They're 150 billion behind. And that's why this company has such good price multiples, because Taiwanese stocks have been coming down a lot in price. This stock has always been pretty low, but now Taiwan has come back down to reality. Look at their price to free cash flow, 1.6. That's just ridiculous. This company's 5.4, which is really good as well. The average is 35. And look at their growth, 29%. It's pretty close to Nvidia. And they have a really good ROA, that's net income over assets. It's how well you use assets to generate a profit. And a really good ROE of 50%. That's net income over equity. It's how well you use your equity to generate a profit. So to summarize, I have them trading at a 20% discount. So it's pretty obvious this stock is undervalued. It's just hard to know when it will come up in price. You may have to wait a year or 2 or many years. But I'm pretty confident the stock will go up if they have a similar year as they did in 2021. And there's so much demand for semiconductor chips. All these semiconductor companies can become profitable. There's that much demand. I rank their free cash flows and revenue 7 out of 10 and their ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.